What if I told you the future of money isn't Bitcoin, but digital dollars moving silently behind the scenes? Stablecoins are rapidly changing how the world sends money, from international payments to online commerce. And most people barely notice it happening. But there's another side to this story. Governments are stepping in with new regulations, and blockchain networks like Algorand are positioning themselves to become the infrastructure powering this new financial system. Today, we're breaking down what stablecoins actually are, why regulators are paying attention, and how Algorand became part of the conversation. Stablecoins are cryptocurrencies designed to hold a stable value, usually tied to traditional currencies like the US dollar or euro. Unlike Bitcoin, which can swing wildly in price, stablecoins aim to stay predictable. One stablecoin usually equals $1. That stability makes them useful for something crypto has struggled with for years: actual payments. Imagine sending money internationally in seconds instead of days, with tiny fees instead of expensive bank charges. That's why companies and financial institutions are taking stablecoins seriously. Popular examples include USD Coin, Tether. Together, stablecoins now move hundreds of billions of dollars across blockchain networks. But here's the problem. If stablecoins begin acting like digital cash, governments want to know: who controls them? Are they backed by real money? And what happens if one collapses? Those concerns exploded after the failure of Terra USD in 2022. Billions disappeared almost overnight when the coin lost its peg to the US dollar. That event became a wake-up call for regulators around the world. In Europe, lawmakers introduced MiCA, short for Markets in Crypto Assets Regulation. MiCA requires stablecoin issuers to hold reserves, provide transparency, and follow strict compliance rules. Meanwhile, in the United States, lawmakers are pushing frameworks that demand auditing, anti-money laundering controls, and consumer protections. The message is clear. Stablecoins are no longer treated like experimental crypto projects. They're becoming regulated financial infrastructure. This is where Algorand becomes important. Algorand is a blockchain designed for speed, low fees, and scalability. And unlike some older blockchains, transactions finalize quickly, making it attractive for payments. That matters because stablecoins need efficient infrastructure. If millions of people are sending digital dollars globally, the network processing those payments must be fast, reliable, cheap, and increasingly compliant. Stablecoins like USDC have already operated on Algorand because of those advantages. More recently, regulated European stablecoins such as EURQ and USDQ launched on the network as companies prepared for Europe's new MiCA rules. This signals something bigger happening in crypto. Blockchain networks are no longer competing only on decentralization or hype. They're competing on regulatory readiness. Stablecoins could dramatically reshape global finance. For businesses, they reduce payment costs. For migrants, they make remittances cheaper. For developing economies, they offer faster access to digital financial systems. But regulation will likely determine which projects survive long-term. And networks like Algorand are betting that the future belongs to blockchains that can work with governments and institutions, not against them. Whether that vision succeeds remains to be seen. But one thing is becoming increasingly clear. The next evolution of money may not happen through flashy speculation. It may happen quietly through stablecoins moving across regulated blockchain networks every single day. What do you think? Will stablecoins replace traditional international payments? And can blockchains like Algorand become the backbone of digital finance? Drop your thoughts in the comments. And if you enjoyed this breakdown, subscribe for more videos on crypto, fintech, and the future of money.